Hello! This video considers the second question in the gross income checklist. Recall the first question is what amount is gross income? If there is not any gross income under the first question, you do not have to proceed to the second and third question. It's important to understand that there's multiple methods of accounting for different taxpayers. A cash method taxpayer generally has income upon receipt. Thus, the key is to establish when receipt has occurred. There's three possible ways for the taxpayer to establish receipt: actual receipt, constructive receipt, and cash equivalent. Actual receipt is very straightforward. Did the taxpayer actually receive the item of income? Now, what exactly is cash? We're going to talk about that more in cash equivalents, but the general idea, what you think of as cash, checks, money, and whatnot, is considered cash. The next is constructive receipt. Now, constructive receipt is met when an item has been credited to the taxpayer's account set apart for him or otherwise made available so that he may draw upon it at any time or so that he could have drawn upon it during the taxable year if notice of intention to withdraw had been given. Notice is key in this determination. If the taxpayer does not have notice that the income item is available and subject to the taxpayer's control, then there can't be any constructive receipt. Further, a taxpayer is not in constructive receipt from services just because the services have been performed. So if services are performed, that doesn't necessarily mean that the taxpayer automatically has receipt. Let's consider some examples. Example 1, assume a calendar year accountant performs services in October year 1 and should receive payment upon completion of the services in December of year 1. However, the accountant tells the client upon completion in December not to pay the bill until January year 2. So completion occurs at the end of year 1, but let's say the accountant has an excellent year, is in a higher bracket, and says, you know what, client, wait till next year to pay me. Wait until January 3rd of next year. This was determined after completion or during the life of the services. So this was told during or after performance. In example 2, assume the same exact example, except before the agreement, the parties agree performance will finish in December of year 1. So performance will end in year 1, but payment will take place in year 2. In example 1, under the constructive receipt doctrine, the taxpayer, the accountant, must include the income in year 1, even though the accountant actually receives the money in year 2. In example 2, because the parties agreed before the performance started, this is a distinction. It's out of the hands of the party, and therefore the taxpayer can include in year 2. Now the next concept is the cash equivalence doctrine. The cash equivalence idea is when a taxpayer issues a note or a loan. And the idea is that taxpayers were trying to take advantage of the cash method of accounting because they know that upon receipt of cash for services to record it. So if they can push receiving the proceeds of a loan until the future due to services, then they don't have to record until a future year. If a service provider issues a note to the other party and says, pay me in the future, if the note has fair market value, then it's possible that the service provider has to include the value of the note upon receipt. Because the idea is that unless this is some type of traditional loan arrangement where it's not a special relationship with a service provider, you wouldn't have to worry about this. However, if the loan has a value that's assignable, then upon receipt of the loan, the party must include. Continuing with the discussion, let's consider the accrual method of accounting. So under the accrual method, income is recorded when it's earned and not necessarily when payment is received. We have to go through some requirements here. So first, the all events test. Have all events occurred that fixes the taxpayer's right to receive the income? So the earlier of test, which is the IRS's position, takes place when the required performance occurs, performance therefore is due, or payment therefore is made, whichever happens earliest. So of those three, we have an or test. Whichever is the earliest, that is when income recognition occurs. Now another thing that we have to look at after the all events test is reasonable accuracy. Can the amount of the taxpayer's income be determined with reasonable accuracy? If so, we're going to continue. If not, then we stop and we can't record. Next is doubts as to collection. If there's any doubts with respect to the collection of the items discussed in number 1, number 2, the party does not have to record income. It's possible they'll have to record it in the future, but not this year. The next is contested income. Are there any disputes with respect to the obligation to pay? Is it possible that it's more of a contingent item? If so, again, we have to stop. 5 is advance payments. Has the taxpayer received a payment in advance of either the taxpayer's performance or the due date? If so, then recording happens. However, there's 2 exceptions, and these 2 exceptions are very important. The first exception is the identifiable date of performance. If the taxpayer will provide services on specific identifiable future dates, the income can be deferred until those dates. The other is the 1-year deferral method. Under this method, the taxpayer includes the advance payment and gross income for the year of receipt, but only to the extent such payment is recognized in revenues for bookkeeping purposes in that year. So it can only go up to 1 year. So with these 5 items, it's important that you go in this order. And if you fail any of these items, you stop and you don't have income recognition that year. This completes the determination for when we have gross income.